Next up is Bobby Calder.
Frank has asked me to give you an update on our work in brand evaluation, which is probably about 5 or 6 years old by now. And what I'd like to do in particular is update you on a new standard that we've developed that was just published very recently called Brand Evaluation Part 2, Implementation and Reporting. This builds on the earlier work, but we think represents a step forward with other steps to come. But let me give you a little background to begin with. Many of you have heard this, but we're conscious that some of you may not have. So the background is that we've been working through the International Standards Organization, International Organization for Standardization, which gets abbreviated as ISO, which is an international consortium of countries that develop a very broad range of standards, as you probably know. And their structure is to work in committees, technical committees, of which we are part of 289 Brand Evaluation. The structure is pretty much of a matrix organization, and that each country also has their own standards organization. For the US, it's ANSI, the American National Standards Institute. And so we've been working through ANSI to participate in the international standards development. MASB is a member of ANSI, and as such can hold the sponsorship of this particular technical committee. It has its own US Technical Advisory Group to develop input to the committee, and this is led by ANSI. The participating countries are shown on the next slide. It's a wide range of countries. Not all of them actively participate, but you can see the range from Austria to India, Italy, United Kingdom, United States. Particularly Austria, the United States, and the United Kingdom and Canada have been particularly active. But all the countries vote for a standard. And so the recently approved standard was unanimously approved by all of these countries. One thing I'll note is that, as you can imagine, the practice of marketing differs markedly from country to country, and their needs for this kind of work vary, and you'll see that reflected in what we've done. The standards we developed were, the first one was done some time ago, and which is titled Brand Valuation. Note the word valuation. It established processes for the estimation of the financial value of a brand. The next standard was 20671, Part 1. Notice the name changes to evaluation, and I'll attempt to explain that shift and what the difference between the two. The idea is that both are still operational, but differ in perspectives and solve different needs. And I'll come to that. But this Part 1 standard was basically principles and fundamentals, sort of a stake in the ground and some basic ideas. And then what we intended to do and have done is to build that out in terms of an implementation and reporting standard. Again, not a finished exercise by any means, but advancing the ball another step. Finally, we're more recently branching out into more specific dedicated standards. One we developed is for geographical indicators, which is particularly important in lots of countries, so European countries for sure. The United States is not really big on geographical indications, but it makes sense for us to participate in that as well. And even more recently, we looked at tourism and are in the process, I think on the next slide, Frank, of developing standards for tourism and related services, and particularly in the development of city brands. This is something the Chinese are very interested in. And if I didn't say, they hold the secretariat for this TC 289, meaning that they are the primary sponsor in terms of ISO, along with the United States. So let me say a bit about the brand evaluation part 2 standard, and this distinction between evaluation and evaluation. The 10668 standard was very much of in the spirit of a brand valuation as an accounting driven process, not entirely in every implementation, but substantially an accounting driven process resulting in an accounting number. The basic approaches are called income, cost, and market methods, which pretty much speak for themselves. The market methods is essentially trying to attach a market price to a brand, which obviously you can do in the case of licensing or mergers, but to apply that sort of fair value standard more generally in terms of marking brands to market. Accounting bodies are much more comfortable with a market price for an object, for an asset, than they are for any kind of subjective measure. Brand evaluation was intended from the outset to distinguish itself from valuation, an ongoing project, in that the distinction is not a pre-existing one. But basically, we think of it as a marketing-driven process that provides information about the health of a brand, brand equity, whatever you want to call it, in a series of steps that can fit the development of a brand, and in particular, be adjusted to the stage of branding in different countries. You'll see that reflected in the standard. Some things that appear common in the US are not common in other countries. And so we found in the committee that we really needed to think of this as not just a stage of development, but as sort of the qualitative differences that exist in other countries that bear on this. So let me give you a feel for the standard. The basic steps are brand development, brand strength, brand performance, and financial brand value. Going beyond, as I said, this sort of accounting-driven process. In Europe, for example, you have a lot of smaller firms that really don't behave like the big companies in the US in terms of marketing being a formal, functional process even. And very much that guided the committee in really trying to start at a very fundamental level with how do you actually evaluate a brand at the stage where it's really done in terms of activities and support, a very internal perspective. And then progressing from there to assess the overall strength of what's been developed in terms of its impact on consumers. And then from there to brand performance, which really is intended to reflect actual market choice rather than just the strength of the brand in the consumer's mind. A brand can be very strong and perform more or less well in the marketplace, depending on competition and all kinds of other factors. And then finally, the question of how can you use this kind of process to get a financial number that really reflects the previous steps rather than a more accounting-based end result. So let's take these steps in order and take a look at them. ISO 20671.1, as I mentioned, was intended to establish a basic framework, which is helpful in going through the new standard. The idea, and this is something some countries really were very concerned about, was to specify that a brand really is a result of all kinds of factors in terms of quality, service, innovation, tangible, intangible factors. And all of those were marshaled throughout the organization to constitute support for a brand and brand activities, which is very much obvious from a US point of view, but needed to be spelled out from the standpoint of many countries with different kinds of constituencies. From there, the committee established a framework around how do you go beyond just quantifying support or describing support and activities to actually measuring strength. And we came up with these 5 dimensions that I think are fairly straightforward, but are a little more inclusive than perhaps even a lot of companies in the US really think about this as. legal, customer, stakeholder, market, economic, political, and even financial dimensions. And the idea was to sort of describe and give examples of all of these dimensions in terms of various indicators that can be used. The idea was not to specify any single indicator as the indicator, but to suggest that the range of indicators could be used and they should span these kinds of dimensions. From there, you get the idea that all of these culminate in a factor that could be called brand strength, again, brand equity, brand health, whatever you want to call it. The standard calls it brand strength. And that measures the overall impact in the consumer's mindset of the brand. And from there, to use that to look at brand performance in the marketplace in order to assess what contribution the brand is actually making in consumer choice, and then to base a financial result clearly on that. Some of the hybrid approaches with brand valuation come close to that, but don't really fully embrace it. So we drew this as two paths, the brand evaluation path and the more accounting-based brand valuation path. Now, again, accounting bodies are pretty much committed to the extent they're committed to this at all, to a more of a valuation approach. But we think from the point of view of marketers, this brand evaluation process has a lot of merit and really can be integrated more deeply into a company's decision making. Let's go through it step by step. Brand development evaluation, the so-called step one, an organization shall identify, define, and describe brand activities and brand support. That sounds like a no-brainer, perhaps, but as I say, in a lot of countries and a lot of different types of companies, this is somewhat of a novel idea that you would actually try to specify and isolate these brand activities in order to evaluate them as separate from the business itself. In the standard, we discussed that as an audit, and one consisting of interviews with relevant personnel, where you go through all these kinds of input factors, the tangible, the intangible, quality, service, innovation, and really try to document either quantitatively or qualitatively specific indicators such as staffing, what percentage of staff is dedicated to brand management, all the way through with innovation, product development, what percentage of revenues is invested in research and development for the brand. And we try to give examples of these indicators and a structure of how this kind of audit could be done without specifying a single audit instrument, which would be very difficult to agree on across countries, but establish a template for doing this kind of thing that could be developed. So that's the step one brand strength stage. The word we use is shall be included. In ISO language, shall is pretty much a mandatory requirement. So the idea is that every firm should do this, to have an audit document that basically documents what they're doing from a marketing support and activity point of view. Now, step two is the brand evaluation step. That'll be familiar to most of you as your standard kind of tracking brand health kind of exercise. But the idea is that included in this should be all of the dimensions, legal and not just customer stakeholders, but even economic, political factors, and some financial metrics. So for each dimension, one or more indicators shall, note the word shall, be chosen and the rationale for their selection discussed. Proceeding from the obvious for us, things like brand awareness, to perhaps the metric of enforcement of trademarks and that kind of thing. The idea is that where possible, you would consolidate this in a single measure of brand strength, but where the combination doesn't appear to reflect the specific indicators, you might create some sort of scorecard. So again, pretty much consistent with U.S. practice, but not so in other countries so much. But to go through this Brown Health tracking exercise and come up with some specific indicators of brand strength in the mindset of the consumer. Now, step 3 is the brand performance evaluation, and that's a little more novel even for the U.S. The idea is that to establish a process for measuring brand strength that shall proceed as a next step to this performance analysis in the marketplace, shall document and validate indicators of brand strength on customer choice within the market. Performance is based on a comparison of the brand to an unbranded or weakly branded product that is otherwise comparable except for price. To our mind, this is a key insight and one that really drives this performance idea. What you're really asking is a counterfactual, how the firm would have performed absent the brand, how does it perform with the brand, and then how would it have performed without the brand, the comparison of the brand to itself absent the branding. There are two obvious approaches to this in the literature. One is the reveal preference, where you use actual market data for this kind of comparison, typically against a weakly branded or perhaps even generically branded comparison that's otherwise quite similar. The other is more of a stated preference approach, where you use consumer research data with techniques around simulated discrete choice experiments, where you actually have consumers state their preference for a branded and unbranded product. And note that one of the advantage here is it is consumer research data rather than market data, but that has some advantages in that you can actually get people to make choices that are not observable in the marketplace in this kind of environment. So as I say, the key idea here is to go beyond strength and really associate the brand with a measure of performance in the marketplace relative to what that performance would have been without the brand. It's not a competitive comparison. It's not saying your brand is better than other brands in the market. It's just that its strength is manifested in a performance that's better than what it would have been without the brand. The financial brand valuation is meant to be a knock-on effect of all of these, so that you move from brand strength to brand performance, and that indication of performance in the marketplace is used to obtain a financial result against a cash flow that you had with the brand that you wouldn't have had absent the brand, the differential cash flow. And simply discounting that over future periods gives you a financial value of the brand. Now, there's lots of different ways you could look at that cash flow, and lots of details in the execution of this, many of which are still open territory. But in principle, we wanted to put this out in front of people as the definition of a brand evaluation, ultimately when it takes a financial form, and indicate how that's different from a more accounting-based brand valuation. Now, the reporting side of this is something the standard goes into in some detail, because that's such a key issue. One thing we say is that the brand evaluation report should include steps 1, 2, and 3, shall include steps 1, 2, and 3. That's a pretty strong mandate in terms of agreement among countries. Remember what I said about step 1 even being a tall step or a new step for some environments. But the idea was to really put it out there that a firm, if it's really conforming to the standard, really shall be doing 1, 2, and 3. That, as I said, represents kind of a leap forward internationally. We say the report should include step 4. Should is a slightly different level of mandate. Should is a strong implication that that's what it says. You should be doing this, but it's not. We thought that making it mandated as a shall might detract from attention to the standard. Might be too much at one time. So we introduced it as a strong should. We say the information should be reported internally to executive management, but does not have to be reported on financial statements. There's been a big debate over the years about whether this type of thing should go in the balance sheet. And we finally come to the conclusion that that's not even necessarily not necessary, and maybe even not necessarily a good thing. But it should be reported through financial statements in one way or another. And there are a number of different possibilities for that, and they vary by country. And that it can be reported externally to investors and creditors. That's not even a should. It's just can be reported. In our view, it would be highly desirable to have that kind of information for investors, but too strong a step at this point to try to make that any kind of mandate. The brand valuation shall be conducted regularly over time, at least annually, a fairly strong statement. That at least annually you should be doing this, and it should be used as part of a process, and this picks up on some of the things Joanna was saying, to continuously improve the brand and its derived financial return. We don't think of the standard as just merely a yardstick, but as really the basis for the effort to continuously improve brands over time. MASB has recognized for some time that there's this disconnect often between marketing finance, and what we're really trying to do is bridge that disconnect so that you really have finance just not monitoring marketing from a cost point of view, as is often the case now, but really making investment decisions with a basis for doing that in terms of the actual financial value of the brand, so that these first three steps we talked about become integral to finance, driving marketing, and making a consumer impact, and a feedback loop back to finance is to evaluate what that investment is on a real return to the investment made, and the value of the asset created. And we feel that naturally over time is the kind of information that investors are going to want, and there's a natural kind of evolution to in some form getting that information out there, so that you have really this continuous chain of improvement over the four brand evaluation steps, finally for inclusive for the company. So that's an overview. Why don't we see if there's any questions that we raised in this? I hope this distinction between valuation and evaluation is a bit clearer. And the idea is that we're trying to develop this over time and sort of lead the way to companies embracing this and actually incorporating it as a major part of marketing management.
Hi, Bobby. We do have a question from Jim Meyer. He has his hand raised. Jim, you should be able to unmute and speak now.
Yeah, thanks, Frank. Hi, Bobby.
Hi.
Is it correct for me to infer from this, let's say an enterprise is very much in their infancy as it relates to brand evaluation and valuation, that would it be reasonable for them to really focus first on becoming really good at steps 1, 2, and 3, and maybe just saying, hey, step 4 is maybe a bridge too far for us at this point. It might be a bit intimidating. It might produce too many, interesting, well, maybe reasonable, but unnecessary questions. Is that the way a specific enterprise could approach this? And then Frank, I might have a follow-up here for Frank or Joanna. Thanks.
Yeah, that's very much the way we thought about it. I perhaps emphasized too much the resistance side, thinking more of the U.S., but it really is, from the committee's point of view, that step 1, step 2, and 3 is a large ask for, in a lot of cases. And step 4 might just be too much complexity. So the idea was to try to get people to 3 in a lot of countries for sure, including some companies in the U.S. Although obviously many companies are at step 3, but to make it a more manageable process. And it's a cross between pushing and coaching people, and we're trying to do both at the same time.
Yeah, because it seems in an ideal world, as you communicate this to executive management, you might also include a board in that. And yeah, getting folks trained, on 1, 2, and 3 is probably a bit of work in some cases, and it would seem step 4 is, that's graduate level, or that's doctoral level work in some cases for certain enterprises.
Yeah, we didn't go directly into corporate governments because of the different countries involved, but it very much has that implication.
Yeah, my follow-up for Frank or Joanna then is, I'm thinking about, I think it was step 2, the audit. Is that something MASB can help enterprises through? Is that something that MASB would provide as a service?
Let me jump in. Absolutely. And I was actually had my hand raised to say pretty much to address that point, is that a lot of people really don't know what brand valuation is or how to do it, which is why this kind of work I think is so valuable. Well, what MASB offers is a set of services to companies which they can use to where we can advise on, what if you want to link your brand to financial incomes and demonstrate its value, what is the right way to do it? Whether you want just a number or whether you want a more in-depth brand valuation, which looks at not just how much value is our brand creating, but what are the levers through which our brand creates value, and what investment strategies or brand strategies should we adopt to drive the value of the companies. And depending on what questions you want to answer, whether it's ROI from investment in marketing, or whether it's strategy, or whether it's just a number for, I don't know, tax or M&A purposes, or saying, can we, improve our brand portfolio architecture, whichever that is, determines, how you should be thinking about a brand valuation, how you should structure it. We also can jump in, and some of this is included with membership, do metrics audits to say, well, if you want to value your brand, how much of the data that you need do you actually have? And what would you need? What other metrics would you need? And that is something that is really, very much in MASB's audit and advisory role. We won't do the actual brand valuation for you, but we can advise you on what metrics, what you have that you can use and what you don't have, and what you need to fill in, how you should use them, and who else from outside should work with if you feel you can't do it yourself and you need an outside specialist to help you with the brand valuation, because we have a number of accredited brand valuation providers. So it needn't require a PhD, because we have people with PhDs who can help. And actually, I was going to say, and some like me you don't, but I do, in fact. So yes, we have people with PhDs who can help. Yeah.
All right. Well, thank you so much, Bobby, for bringing us up to date on the standard. It's been exciting and I know it's been a long process to get these through. So congratulations on all that work.